Welcome back to The Explainer. Today, we're jumping straight into Chapter 5 to completely demystify the anatomy of the government budget. We're going to figure out exactly how a government manages its money. If you've ever wondered how those abstract numbers in a massive national ledger actually shape the roads you drive on or, the taxes you pay, well, you are absolutely in the right place. Let's get into it. So why does the government even need a budget, and how does it actually affect you? I want to start with this fundamental question just to ground our focus today. Because a national budget goes way, way beyond a simple household ledger. We aren't just talking about paying the electricity bill here, we're talking about the primary engine that shapes economic life, builds infrastructure, and literally impacts the money in your pocket. Think of the national economy like a beautifully intricate, massive machine. Money flows outward from that central budget briefcase into literally every corner of our lives. It's powering industrial production, subsidizing agriculture, funding the infrastructure we rely on every single day. It's this vast, interconnected system. And today, we're going to break down exactly how the whole shebang operates. All right, here's our roadmap. We are covering the state of the mixed economy, the anatomy of the budget, providing for the public, taxes and the GST, the multiplier effect, and finally, deficits, debt, and balance. Section 1. State of the mixed economy. We're going to kick things off by establishing the specific economic environment we live and operate in today. A mixed economy is an economy featuring both the private sector and the government playing really important roles. This simply means that while private markets and businesses drive a massive chunk of the economy, they don't do it alone. The government absolutely has to step in to fulfill crucial functions. It's a dynamic partnership, right? And the main tool the government uses in this partnership is its budget. Moving on to Section 2, Anatomy of the Budget. Let's open up that proverbial briefcase and see how all this money is officially organized. Now, the crucial point here is that this budget isn't optional and it's definitely not impromptu. Article 112 of the Indian Constitution legally requires the government to present an annual financial statement to Parliament. This covers the estimated receipts and expenditures for every single financial year, which predictably runs from April 1st to March 31st. This document is literally the absolute blueprint for the nation's year ahead. Because government decisions have massive ripple effects, the budget is neatly split into two very distinct accounts just to keep things organized. On one side, we've got the revenue account. Think of this as the day-to-day operations, money coming in and going out just for the current financial year. Then, on the other side, we have the capital account. This is the long game. It tracks the assets and liabilities of the government, basically those investments and debts that will impact the country well beyond just this current year. Now, focusing on capital receipts, notice how the money coming in here isn't just free cash. It usually means the government is either taking on fresh loans, which creates a liability they have to repay with interest, or they're reducing financial assets by selling them off, like PSU disinvestment. So every capital receipt is essentially either debt-creating or non-debt-creating. It's a really delicate balancing act of managing future obligations. Section 3. Providing for the public. With the balance sheet organized, we arrive at the allocation function. Why exactly does the government need to spend all this money? Well, the simple truth of a mixed economy is that the government provides certain goods and services that cannot be provided by the market mechanism alone. Private markets just aren't designed to provide everything society needs. They rely on direct exchange between consumers and producers. But what happens when a service benefits everyone, regardless of who pays? That creates a massive gap that the government has to fill. We call these public goods. We're talking about absolute essentials, national defense, the roads and infrastructure we use every single day, and basic government administration. You can't really charge individual citizens a private market rate for national defense, right? It just doesn't work. So the government uses the budget to allocate resources to make sure these critical public goods are provided for everyone. Which brings us to Section 4, Taxes and the GST. Providing all those public goods is wildly expensive. To fund them, the state relies on the fascinating and, often controversial world of taxation. July 1st, 2017. This specific date marks a massive, historic shift in how the government collects its revenue through indirect taxes. It was the dawn of a completely transformed tax landscape in India. The core philosophy behind this shift was brilliantly simple. One nation, one tax, one market. Before this, there was this confusing, cascading web of different central and state taxes. The Goods and Services Tax, or GST, came in and amalgamated this large number of disjointed taxes into a single comprehensive system. Let's break down what that actually means on the ground. GST is a destination-based consumption tax. with a really clever facility called input tax credit built into the supply chain. Basically, it streamlined the entire process right from the manufacturer down to you, the consumer. By letting businesses subtract the taxes they already paid on raw materials from the taxes they owe on their final sales, it prevents a tax-on-tax scenario. It ensures there's just one unified rate for one type of good or service across the entire country. So taxes come in and spending goes out. But what happens when government spending exceeds tax revenue? Let's transition to the macroeconomics here and ask what occurs when the money flowing out for public goods totally outpaces the taxes coming in. Section 5, the multiplier effect. This leads us to one of the most fascinating concepts in this entire explainer, the math behind government spending. The government spending multiplier is the mechanism where an initial increase in government purchases leads to a larger total increase in economic output. When the government spends money, it doesn't just disappear. Say they spend $1 billion on a new highway. That pays construction workers, who buy groceries, which pays the grocer, who buys a new car. It creates this powerful ripple effect. An initial injection stimulates a much larger total increase in production and income. We can see this clearly in the aggregate demand equation, where total output, or AD, equals consumption plus investment plus government purchases. Because government spending, that G right there, is baked into the formula, injecting money literally shifts the country's entire demand curve upward. Firms expand production to meet this new demand, and boom, you get higher equilibrium levels of national income. But what's really interesting here is understanding how taxation acts like a natural parachute. Proportional taxes actually make the value of the multiplier smaller compared to a lump sum tax scenario. If a government uses a proportional tax system where your tax bill rises with your income, it acts as an automatic stabilizer. Instead of all that new money infinitely cascading through the economy, the tax system pulls a fraction of that newly generated income right back out, mathematically slowing down the powerful multiplier effect. Section 6, deficits, debt, and balance. Finally, let's look at the actual consequences of utilizing all this spending power to drive the economy. When you listen to the news, these words are often mixed up, so it is absolutely crucial to separate these two terms, deficit and debt. A deficit is strictly a yearly measurement. It happens when G, government spending, exceeds T, taxes, in a given current financial year. It's a flow. Debt, on the other hand, is the accumulation of what the government owes over time. It's a stock. Basically, the government's deficit today becomes the government's debt tomorrow. And that brings us to the ultimate tightrope walk of government economics. How do we balance the immediate power of the multiplier effect with the long-term reality of national debt? I really want to leave you with this provocative thought to ponder today. We know spending boosts demand, but at what point does the cost of financing our public goods outweigh the economic growth they create? It's the central question every national budget tries to answer. Thanks for joining me on this explainer. Keep exploring these concepts, and I'll catch you next time.